Hello, traders. I'm Emily Advani of NewsWare's Trade Talk. Welcome to the latest edition of NewsWare's AIQ Markets podcast, where we bring together expert insights on fundamentals and technical analysis on the financial markets. At NewsWare, we provide the facts, themes, and trading ideas for the day ahead, and then combine that with AIQ Systems, which is a leading provider of intelligent technical trading analysis. Its algorithms identify high probability market trend changes, helping users navigate volatile conditions with precision. And speaking of volatile conditions, since the last episode, markets have experienced heightened volatility driven by a rapid sequence of tariff escalations, temporary deals and reductions, and now a recent court-ordered lifting of the tariffs. So, Bill, I am going to start with you, Bill Olsen of NewsWare's Trade Talk. What is your assessment of the market action since our last episode?
You're right. It was a period of intense volatility. I mean, particularly following the escalation of the tariffs and trade tensions. The trade tariffs were pulled back. They were increased. They were pulled back. Trade deals were occur. I mean, the fact of the matter is, the worst of the sell-off happened in early April. Around April 8th was like the worst, was the bottom. But there are certain stocks that, low volatility stocks that, were able to hold up. Coca-Cola, MasterCard, they outperformed as, the market was looking for safety trades in that period of uncertainty. So, those seem to do well. But you look at the markets and they broadly underperformed as compared to a lot of the global markets. I mean, you look at the overseas markets and they were hot. They were, Asia was posting gains, European markets, especially the DAX. The DAX really had a strong period. But the tariff deals and subsequent reductions, proved extremely helpful for market sentiment. And so, we did start seeing that liftoff in May when they started to come around. So things are much better than they were after Liberation Day. And we do have the summertime, period. We could have a nice little rally in the summer. As a result, we're going to be going into July earnings, and my fingers are crossed for a good, strong reports, Emily.
Bill, we're also joined by Steve Hill, the CEO of AIQ Systems. And Steve, I'd like to sort of get your analysis on the market sentiment since our last podcast and sort of how you're using AIQ Systems to, make an assessment on the markets. We're certainly dealing with unprecedented conditions, and it seems to me that the more tools we have at hand, the more accurately we can navigate these, bumpy, choppy waters. So, Steve, I'm going to turn it to you, sort of your high-level view of what's going on and how you're using AIQ to continue assess the conditions of the markets.
Yeah, thanks, Emily and Bill, for having me on the show again. It's been a very interesting month since we last talked. I was looking in depth at the sector analysis for the S&P 500. Just to give you a quick overview from our technical point, and this is really trend status changes. The information technology is still doing very well throughout the last month. The bottom of the pile, so to speak, is real estate seems to be still in a sort of a slow downtrend. Not a lot happening in that area. I remember in the last podcast, we also talked about some of the consumer products and also utilities I had as which was an interesting area. I don't usually look at utilities, but utilities is still powering pretty strongly to the upside. The big, obviously, Liberation Day and that massive sell-off and all the rally since then, there has been a sort of a broad market rally overall. And it's just a few of the sectors that are sort of lagging behind. The two bottom sectors in my sector reports within AIQ are consumer discretionary and real estate. And they're in a sort of a modestly low trend, I would call it, rather than being a powerful trend. And again, the trend itself is a great place if you like buying into the trend. So information technology and industrial are still at the top of my list here. But again, that's the macro view on the sectors. What we do is we then drill down inside those sectors. And a little bit later, I'll talk about one of the groups that's a little surprising that's doing quite well. And, something that we haven't talked about before as far as a an up and coming or a powering ahead group rather than a sector, which is a more micro view.
And Steve, we will look ahead to that information in just a moment. But before we start to look ahead, a deeper analysis of what's going on right now and where we may see some opportunities coming up, Bill, I do want to turn it back to you. And you give us a feel of the markets. But since we last talked, as Steve mentioned, we had some analysis on where we should be looking, what sectors we should have been looking at in the last episode. So let's sort of do a recap on that before we get to what to look ahead to. So, you mentioned healthcare and grocery store stocks in the last episode. Give us a rundown of what happened in those sectors since we last spoke.
Yeah, you have to put the timing in context here because we knew that the tariffs were going to be announced, in a couple of days on our last episode. So I was looking for safety, and healthcare and grocery store stocks are typically safe trades. You know what else is safe? Telecom. Telecom's another safety trade. I went with healthcare, and you look at some of the stocks I was talking about, Johnson and Johnson. I called for a 148 entry price. It moved below the 148, and then it rallied up more than 10%. You look at Merck; it's a 6% gain off of the $80 entry price I spoke about, and CVS. Well, it never hit my $55 entry price. It came close to 60, but it did jump up to $72. So, that was positive. And in terms of the grocery stores, Kroger, I called it 62 and a half. It ran up to 75. Walmart, I called it at 75. It fell to 79. I thought it would fall a little more with the Liberation Day, but it didn't. But then it rallied up to 100 points. And Costco, again, I called 825 as my entry. It fell to 850. And, you look at it today, it's trading over $1,050. So, they were all positive ideas. And that's because those sectors were a little bit insulated from the tariffs on one hand. On the second hand, that they had the ability to continue to show positive action, even with, the worst of the tariffs being thrown out there. So, we made some pretty good calls on the last episode, Emily.
Bill, I think that's proof that combining, this news, information, and data along with the technical analysis from AIQ does work. And, with sort of all those wins there, and you were able to really navigate these latest situations in the market. I'm interested to hear looking ahead. What are you looking at? What sectors are you looking at? What stocks are you looking at? Where do we see some opportunity in the coming months?
I got to tell you something. I do like some of these transportation and beverage stocks. Remember, Coca-Cola was kind of immune from this recent sell-off. But, I do think Pepsi-Cola, ticker PEP, has the ability to turn around. I mean, they're launching a new marketing campaign this year, and it's really to connect with Gen Z. They're doing TikTok videos, they're doing, more events, and they've got all brand new commercials coming out, and their business is more than just soda. They also have they own Gatorade, Tropicana, Lay's potato chips, Doritos, Ruffles, Quaker Oats, those Stacy chips, and a lot more. And you got to consider a staple, and it really has been underperforming this year. And the stock does have a 4.35% yield, so I like it. The risk is RFK, in his Make America Healthy again, but I think the lobbyists will be able to prevent him from doing too much. And so the worst is kind of in. And if I can get in Pepsi Cola at under $130 a share, I think that's going to be a good call. Another one I like is in the transportation sector, UPS, United Parcel Service. Hey, fuel costs for ground services account for 20% of each package delivery. Fuel costs for air services account for almost 30%. Now, oil prices have fallen from $72 a barrel in March to, around 61, which is where we're at now. And I think they're going to even move lower because OPEC is expected to increase their production in June and July, and that's going to create additional supply, which should lower oil prices. And, you look at the yield on UPS, it's 6.78%. Um, you know, If you can get in under 100, I mean that should be very good because 100 is kind of a support level there. And you look at the SEC filings, I see Morgan Stanley's buying Goldman Sachs, two different divisions. Even Goldman's, the private groups at Goldman Sachs are increasing their positions. So my target price is to get in at 96, and let's see if we can get some 10% gains on UPS and Pepsi Cola. What I don't like, Emily, is the airline industry. The airline sector it's got a lot of issues. It's not getting we're going to be losing traffic from Canada to the US. We're losing traffic from Asia and Europe to the US. And in the US, we now have the real ID. You need to have a passport to travel in the US. Only 50% of Americans have passports. So you can't just get on a plane and fly anymore with a regular driver's license. You're going to need a federal document. This was started in 2005 and pushed through, and it finally became effective in May. And I think it's going to curtail air traffic, and you're going to see it, in their numbers when they release, later this summer, because the May and June traffic will be in those July numbers, and I think air travel is going to really be slowing down to a crawl, and that's going to hurt the airline industry. So I'm kind of negative on it. Steve mentioned something about weakness in the real estate sector. I mean, I like the real estate sector overall, but I can understand the weakness because interest rates are going lower. We know that, but the 30-year mortgage interest rate, which is what a lot of organizations use when they're taking over, when they're making loans, that's going to continue to stay high. The fact of the matter is that the interest rates from the Fed and the interest rates on the 30-year bond, they're different interest rates, and those are going to remain high. So I don't see a turnaround really in the corporate real estate market and real estate stocks. So I'm not surprised that it's weakened, and I don't see a turnaround yet. But it is a good. It always is a good sector, but I'm not a big fan of that one either right now, Emily. But that's what I have for my update as well for work to trade for the upcoming quarter, Emily.
So, Bill, I'm hearing you're positive on Pepsi, UPS, that's sort of transportation and beverage stocks sectors there. Not hot on airlines. And then, continuing to watch real estate may be important. Some weakness now. Overall, as you mentioned, a solid sector, but, not as solid as it has been. So I want to layer on, AIQ Systems, Bill, to your analysis and bring Steve back into the conversation here. You did give us a little bit of a preview, Steve, about what you're sort of witnessing right now, along with opportunities to look ahead to. So, Steve, give us your analysis on what is worth watching coming up.
Yeah, it's interesting on the airlines. We were talking earlier about transportation. As far as people is concerned, it's definitely, I traveled quite a bit most years, and I came on planes with 30 to 25% to 30% capacity on an international flight, flying into Denver or San Francisco. People are just not traveling that much at the moment, which is, doesn't bode well for any of the major airlines. In fact, all of the airlines. As far as talking about Bill's picks on PepsiCo, interesting group. So the soft drinks group within the S&P 500 has four stocks in it. Keurig Dr Pepper, it's got Coca-Cola, of course, it's got PepsiCo, and it also has Monster Beverage Corp, which I always thought would be one of those stocks that would be kind of targeted by the sort of the healthy look on thing, because those beverages are high on caffeine, and not a lot of the younger people are very much into that. And I think that PepsiCo's move to kind of leverage into the get a sort of a more younger image in their product line is probably not a bad idea, since Monster Energy has really gone crazy. I mean, it went from, in May we're looking at from 57 or so up to 64, but it's been in a trend up for a long time. But PepsiCo itself, like Coca-Cola, both have been knocked down pretty severely. But what I like about PepsiCo within that group, Monster Energy is obviously a big leader in there. Keurig, Dr. Pepper have sort of been knocked down as well as Coca-Cola, but Pepsi-Cola's got a nice bottoming pattern, had a little bit of a double bottom in place. And one of the indicators we use, moving average, convergence, divergence, one of the most widely technically used indicators, there's great divergence to the upside. When you see that, generally that's the sign that there's a bottom in place, and you could see some movement to the upside. So I like PepsiCo as well. Oh, and by the way, it's just sort of dropped, running just above its 21-day average, which is a good sign. If it can stay above that area, then there's some sign that this bottoming is good. Talking about Bill's other pick on United Parcel Services, UPS. When I look at that particular group, which is the air freight and logistics, it's had, there was a real jump up in May for the whole group itself in early May, and then it sort of fell back down to fill in the gap from when it gapped up. The other stocks in here include obviously Expeditors International, FedEx, of course. FedEx and UPS are fairly similar charts, although FedEx hasn't been knocked down as much as UPS. But UPS, again, is a pretty good bottoming pattern. There's sort of a four tested areas around about the 94, 95 zone, where it's really found a good sort of bottoming area down there. And my favorite indicator, moving average convergence divergence to the upside, is, it's strongly up, even though the chart pattern has been sort of in a bottoming area. That's another great sign. So both of those stocks look good to me. The only other sector or the segment that was interesting when I was doing a class the other day was not stocks that I'm particularly into, but tobacco, which is amazing to see that things like Altria and Philip Morris particularly, both of the stocks within the S&P tobacco group. The group itself has reached a really good topping area, and both Philip Morris and of course Altria are looking like they're going to continue to move to the upside. They're just moving along the moving average, and there's money flowing into these stocks for whatever reason. Not always a favorite for health reasons, of course, but technically very good, very strong looking stocks.
Steve, I'm interested to hear, you added that analysis to Pepsi and to UPS. You did give us that additional insight into the airlines, and, pointing to tobacco. But are there things that you're steering away from as you look at your technical analysis, besides the airlines, that you think are worth you putting on the back burner at this time?
Yeah, I mean, real estate, as Bill was saying, it's a pretty safe place to go. I mean, it's not going to make a lot of money for you because again, the market because of interest rates. But I don't, as a technician, there's not a lot going on in the real estate area that interests me. Every time I look at the sector itself and what I have in the sector, when you go in, we drill down inside the sector into the groups in here. You've got real estate services. You've got, let me see what else we have in here. Real estate services has been knocked down pretty hard. It's not doing great. Again, it's moving sort of in a sideways pattern at the moment. And let me see, the hotel and resort, the REITs are in here, the real estate investment trusts. These have all kind of moved off of a sort of the low in April. But again, they're sort of challenging to get through a 21-day average at the moment. Office REITs are really, really knocked down. I mean, they're still knocked down. It's traveling below its 21-day average and pretty close to its bottoming area back in April. So that's, again, real estate I'd probably avoid. The other one I have in my sector analysis here, which was consumer discretionary. And so the discretionary, of course, is when money's tight and there's a perception that money is tight, you get into a situation where some of that luxury goods areas are under pressure. Apparel, accessories, and luxury goods had a nice rally actually in May, but it's definitely falling back again now. So I'd probably avoid both of those sectors at the moment. So that's the consumer discretionary and real estate. Technically, not looking great.
And Bill added in the airlines to sort of the one
Mm.
to watch with caution, coming up. And then we heard plenty of opportunities to look for in the coming months, and the coming quarter as we head into the summer. Now, Bill, before we sort of wrap it up here, I do want to tag you back in to see if there's anything else you'd like to add to Steve analysis.
This court order that they're going to be lifting the tariffs. You got to pay a little attention to tech because that really does have the ability to turn around and start moving higher. If they have it, but you still have issues about not being able to sell chips to China. You still have issues about Trump putting on executive orders of who tech firms can sell to and who they can't. But there should still be some momentum left in the tech trade, and so I'm not throwing that away. But I'm much quicker on those trades. I'm in and out, on a very short-term basis. Capturing a run, then walking away from it. I might not capture the full run, but I get a nice gain on some of these trades, and that's really what I look for, Emily.
And Bill, so you have it there with Pepsi, UPS, keeping an eye on tech, steering clear of airlines right now and being cautious on real estate. And Steve, you're saying yes to some interesting indicators in tobacco, are backing those Pepsi and UPS picks, that sort of beverage sector there. And again, you're looking to keep real estate in the back of your mind, not really at the forefront, and keeping an eye on consumer luxury goods may not be the best sector to play coming up. So Steve, before we let you go here, any last tidbits to add?
Yeah, I've from our total macro view that we have technically within our system, our market, which is an AI-based analysis of the market itself, and both the number of stocks advancing, new highs, new lows, a lot of different slicing and dicing of the price history and technical action. We're currently on a sell signal for the market, which is interesting, has been for 4 days. It's a little mixed out there. I mean, the internals are pretty bearish in some of the areas, like the amounts of advancing issues versus decliners. Although the new highs and new lows are actually in the opposite direction. So there is a little bit of flux in where the market is right now. But certainly from a short-term view here, there's definitely a sell signal for us on the market, which says, things may well pull back a little bit from where we are.
Both Steve and Bill, these expert insights are invaluable, and we thank you for those on today's special episode. Bill Olsen, thank you for your expert insight, as always. I'd also like to thank our special guest, Steve Hill of AIQ Systems, for joining us today. And if you're looking for more information, trying to access Newsware and get the facts, themes, and data for the trading day ahead, you can go to www.newsware.com. If you want to combine that with the technical analysis that you've heard from Steve Hill throughout the show, check out AIQ Systems. Go to www.aiqsystems.com. Thank you, Bill. Thank you, Steve, for joining us today.
Thanks, Emily. Thanks, Bill.
Thank you.
Again, I'm your host, Emily Advani. Traders, you know what to do. Let's go out there and make some green.